Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have back with us Judy Carlson, who's a fee-based fiduciary financial professional, and we'll be talking about the importance of tax elimination strategies prior to wealth distribution. Judy, welcome back to the program.
Glad to be here, Mike.
Hey, so I love how when we talk, you always have some great examples and points and stories and ways to apply. So I'm excited to talk about this. And I think this is such a huge topic because it's like the cart before the horse. A lot of times people think, oh, better do this. And then, oh, as an afterthought, I guess we should have done that beforehand. So get us started with what we should be thinking about regarding tax elimination strategies prior to wealth distribution.
It's a great question, Mike, and I've been a CPA for almost 40 years. I've done a lot of tax returns for people in their 70s and 80s, and the thing that hit me the hardest was how unprepared they were for the downward spiraling tax cycle that they get into once they hit the Social Security claiming strategies at age 70 and now RMDs at 72. So we've got all this money coming in, converging. And then they've also deferred taxes on a lot of their money. So they've got all this money coming in and it all hits the 1040 and they're shocked at how much they're paying in taxes, even when they're retired and they're not getting that weekly or monthly paycheck.
Yes. I guess timing jumps to my mind, the timing of doing things right. So you need to make sure that you are doing things well enough ahead that it's going to actually take effect the right way. Well, that comes with timing, right? So what do you find is some of the risks and, to managing money the right way and not losing it once you start kind of distributing or decumulation of your wealth?
So all of us are paying taxes on our earned income as we go through our careers. However, a lot of people are postponing paying taxes on some of that money while they're earning it, and they're sending it to their future. Well, when their future comes in their retirement years, it's still income and it still hasn't been taxed. So some people are sitting at 60, 65, 70. They're preparing for their decumulation years, and they look at their statements and maybe they've been able to accumulate, let's just use a big round number because it's easy, $1 million in a 401k or an IRA or a SEP plan or solo simple, any of those. And the traditional financial planning approaches are just keep the money in there and then distribute it and pay the taxes on it as they're owed over the course of your retirement. However, we have this very powerful software, very robust, where we can put in current scenarios with people who have money in various accounts and they're preparing for retirement, and we can run, if you were to do nothing, what is your lifetime tax bill going to be? And even though you may only have $500,000 or $1 million saved up in a tax-deferred plan, your lifetime tax bill, if you do nothing, is going to be well over $1 million. So is that something you really want to pay? Because when RMDs, required minimum distributions, kick in, Social Security starts coming in, the income starts coming in from these tax-deferred retirement plans, what if in your 50s and 60s we could start to do some lifetime tax reduction or even tax elimination strategies that would then prepare you to, hey, what if you didn't have to pay any taxes once you entered your decumulation years?
That would be pretty cool, yeah.
Yeah, do people even think that's possible today?
Right. No, because they don't think there's some big corporate tycoon that knows how to, use techniques that they have no clue of how to do, but yet it might not be possible to pay zero, but you can mitigate it right on down, right?
Exactly, and it's interesting because I'm a fiduciary. You mentioned that, a fee-based fiduciary financial professional. And in my opinion, that goes well beyond the 1% fee that is getting charged on assets under management, because if you're not helping your clients keep as much money as they possibly can for the rest of their lives and eliminate risks to the safety of their money, like downside market risk, lifetime tax liabilities, building guaranteed streams of income they cannot outlive, doing maximum Social Security benefit claiming strategies, or what if there's a chronic or critical illness or a long-term care event. All of this all comes together. All, in my opinion, as a fiduciary, I need all those puzzle pieces to come together for my clients in order for them to feel like their money is being protected financially for a lifetime.
Well, I love the conversation we're having, which is let's deal with taxes to lessen, mitigate, eliminate, whatever that looks like potentially, before you start, getting to where you need to transfer money in retirement. But taxes is such a big thing. And, what's the tax code? 70 gazillion pages, who knows? Yep. But it's like a big, big, big question mark. And taxes are huge impact of retirement. What is it recently in recent decades that makes Americans pay so much of taxes during the years that they're no longer earning income? Well, it's one thing to see your paycheck and go, oh, okay, well, the gross was X, so the tax is taken out. Okay, here's at least what I got. But what about taxes during the years you're not earning income? How does that work?
Well, it used to be people earned income, they paid their taxes, and their employer set aside money for their pension, and then they were paying into Social Security, and when they started retiring or decumulating, they got their guaranteed dependable pension check from their employer and their guaranteed dependable check from Social Security. And while some of it was taxed, it was minimal because all the taxes had been paid on their earned income prior to retiring. Well, then the 401k plan was signed into the tax code in the early 80s, and the burden shifted from employers helping employees provide for retirement income to now employees trying to figure it out on their own. So now when they're getting to retirement age, hopefully they'll still have their Social Security coming in. And then the other part that used to be pensions, I call it, now you figure it out, because what are we supposed to do? Trust that putting money in a company 401k plan or a traditional IRA or SEP plan is going to provide that other 60% of our much needed income in retirement? No, it's not. And not only that, it's going to complicate retirement from a tax perspective, because now we have to pay taxes on income that we earned 30 years ago at tax rates down the road that we have no idea what they're going to be.
Yeah.
So the last 40 years have really complicated retirement planning for people, and most people just defer to, well, I'm just going to keep my money invested in the market and that should work. Well, that's probably not going to work, especially as we've seen what's been happening in the first half of 2022 here.
Hope. It's like they say, hope is not a strategy.
No, it's not. It becomes even more critical to protect that money and push it through and get it taxed sooner rather than later. I mean, Mike, tax rates have been the lowest the last 30 years they've ever been in the history of taxes since 1913. Are they going to stay that way? I don't have a crystal ball. I don't know if you do. I don't know what people think is going to happen with this taxes going forward, but I want my clients to know that they don't have to worry about who's in the White House or what the economy is doing or what our national debt is, because if they know for sure that the taxes have already been paid on a bulk of their money, doesn't that help them sleep a lot better during their retirement years?
Yeah, it should.
It should. It's interesting. I have an elderly friend in his 80s, and we talk about this all the time, and he's done the traditional financial planning approaches, and he looks at me and he says, you know what, Judy? RMDs are killing me. And so I went back and I thought, now what exactly is happening here? And I'm not going to get into the details, but basically there's a uniform lifetime table that is generated by the IRS, and you take your balance in all of your tax deferred accounts at the end of the year and you divide it by a factor off the uniform lifetime table. It's called the life expectancy factor. And of course, it gets lower and lower and lower the closer to life expectancy you become. But if you have $100,000 and you divide it by the life expectancy factor, you get a number. If that $100,000 grows over the next year and you divide it by a smaller factor, more and more money is coming out of your tax-deferred retirement accounts. Therefore, more and more income is going on your 1040 the older you get.
And less goes in your back pocket to enjoy your retirement. Yeah. Wow.
Yes, that's exactly right. That's the concept. Now, are people peeling back the layers of the onion when they make these initial decisions to know, wow, what are the implications of this decision down the road when I'm no longer working, maybe can't work, maybe are disabled, maybe have had cancer, maybe have had an accident? That's not what we want to be worrying about, but people in their 70s and 80s today are worrying about that, and it's painful.
It makes me think of something interesting that so many times people are like, oh, that's just so pie in the sky, that would never happen, and, the sky's falling and all these things, but the old saying, the only thing sure in life is death and what?
Taxes.
You know what I'm saying? It's like, you're not over-exaggerating things. This is real. It's only getting worse. Just look back 20 years ago. What was taxes are there. They need to be dealt with. They're a drain on your retirement. And so I guess my question is, it seems like this is not talked about in financial planning circles. Why would that be?
It isn't. That's a really good question. And in my humble opinion, a lot of traditional financial planning approaches just aren't familiar with some of the strategies that are available today for tax elimination. Also, I know a lot of them are not properly educated or properly certified to talk about taxes in the decumulation phase. And also, to be perfectly honest with you, to pay your taxes today and never pay taxes on that money ever again the rest of your life requires asset transition. That means taking assets, invested assets from where they are today, where they've been saved for 30 or 40 years, and transitioning them into other types of financial vehicles where maybe you're not going to earn that advisor fee, that 1% fee on that money anymore, because you're transitioning it into a protected asset that is not paid for by an advisor fee. So that's, again, where that rub in the financial services industry comes between, are you going to stay in invested assets, or are you going to go into protected assets that you may not earn that fee on? And most advisors are one or the other, and that's why I'm both. And it doesn't matter to me. I'm going to show them numbers through this robust software. This is what it will look like if you make these asset transitions. And people are like, well, why would I not do that?
Yep.
And if I'm managing the assets, and I got to tell you, it doesn't hurt my heart because I'm moving money from under my management into a protected asset, because it's the right thing to do for the client. Now, if that's not your modus operandi, it's just going to be a different approach.
Yeah. You mentioned several points, strategies, things to focus on, and it seems to me like each one of those makes sense, and standing alone would be a good, solid strategy. But it feels like doing all of these things, or having someone like yourself do all these things in conjunction together, just amplifies it that much more, rather than just the individual, like, oh, you should mitigate taxes. Oh, and also you should, but doing all these together, don't you get like a compound effect?
You do. Yeah, because there's so many like product sales people out there who are like, oh, you need long-term care insurance. Oh, you need an annuity. Oh, you need to put your invested assets in this account because I'll get you a higher rate of return. Oh, what happens if you get chronically or critically ill? And then people have all these different pieces all over the place, and they're not joined together. It's like a jigsaw puzzle when you start. The pieces are scattered everywhere, but it's a beautiful picture when they're all put together and it's complete. And that's what we provide. And it takes strategic and systematic planning, because you don't want to just do one in the wrong order either, because you want to protect your assets from downside risk. And then you want to talk about, how much guaranteed lifetime income do you want? How much are you going to need to pay for daily living? How much are you going to need to play, to go on vacations and visit grandkids? So it's got to happen in a systematic and strategic order, as well as a comprehensive different tools all put together to build this beautiful retirement picture that you don't need to stress about, and you know what's going to come in, and you know what you have to spend.
Mm-hmm. Wow. Well, I tell you, like we said at the beginning of our talk here, you just lay everything out so clearly and precisely. So if someone is hearing this going, you know what, you mentioned something about zero income tax in retirement, or mitigating, or getting as low as possible. If someone's interested in learning how all of these things work together for them, and having you take a peek at what their portfolio looks like, and what some of the recommendations you have, what would be the best way they can reach out and connect with you?
Well, my website is easy to access. It's judycarlson.com.
There you go. It's simple.
That's my name.com, so that's easy. People are welcome to schedule a meeting. Maybe something I haven't mentioned at all, Mike, is that we do all of this on a complimentary basis. We have a very easy process for people to input and upload their financial information through my website, actually, and then I take that and I build out this robust software. I build a foundational plan for them, and then if they're interested in looking at what kinds of moves could actually help them with their lifetime wealth strategy, then we'll run those scenarios together. They can say, well, what if I turn my Social Security benefits on at 67 or 70? What kind of an impact is that going to make on my lifetime wealth plan? What kind of an impact is it going to make on my taxes? So I do that on a complimentary basis. People do need to make a commitment at some point to say, you know what, I do like doing these strategies, or no, I'm just going to leave my money in invested assets. But all of that is available through my website and in meetings with me, and that's my favorite thing to do, is one-on-one with people and their unique situations, and everyone is unique.
Excellent. Well, Judy, thank you so much for coming on today. It was a real pleasure talking with you.
Thanks, Mike. Enjoyed it a lot.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show, or listen to past episodes, visit www.influentialentrepreneursradio.com.